Over the last 12 months, gold has been booming. We have seen the listing of new gold ETFs on the market, and geopolitical turmoil and conflict shows no sign of slowing. The main question investors have is, despite it being at all-time highs, can gold continue to climb? A number of prominent investors believe it can. So today I sit down with General Manager of ABC Bullion, Jordan Eliseo, and talk about the long-term tailwinds for the gold price, but also the practicality of buying physical gold versus gaining exposure through an ETF. One thing I didn't know was that ABC Bullion also have showrooms in the heart of Martin Place, so you can actually go in and see the minted coins, tablets, and bars. This conversation is brought to you in conjunction with our friends at the Australian Shareholders Association. Jordan, let's start off with, mate, how does ABC Bullion make money? What is your business?
It's a great question. Simplest way to think about ABC Bullion is essentially a gold and silver, let's just call it bullion broker or market maker. So we manufacture the products and then we make a little bit of money when we're selling to people. We also make a little bit of money when people are looking to sell and we buy metal back. So on any given day, we have hundreds of clients across our offices, but also online and over the phone, buying and selling bullion through us. And we effectively make a margin on those transactions. And then we also offer ancillary services around bullion trading investment, the most obvious one being storage. So a big portion of our clients choose to store their metal with us. And obviously we charge a fee depending on the nature and the items that they're storing.
So we're talking actual physical gold bars.
Correct. Physical gold bars, physical silver bars. Bullion is also made into coins and minted tablets, but as context for what we do, and this is broadly representative of the industry, around 80% of the dollar value of physical products that's bought and sold are cast bars of gold, those and silver. Those are the ones that have the lowest trading premiums, and then the other 20% is split across coins and minted tablets, which are the items that come in sort of much smaller sizes. People tend to buy them more when they're buying gold, both as an investment, but maybe also as a gift or something commemorative for a special occasion.
Right. And so when you say you store them, do you actually operate the storage facilities yourself, or is it outsourced?
Yeah, no, we have essentially two primary storage solutions that we offer to our clients. So someone can buy bullion through ABC and store it in our wholesale vaults, and we obviously then segregate that stock. We can provide metal account statements to those clients, and that metal essentially, it stays under ABC's control, but it's of course not part of our stock anymore. It's the client's stock. The second option is through a sister company of ours, Custodian Vaults. So it's a separate business to ABC, but that Custodian Vaults is a private vaulting operation. People can use it to store bullion. They can also use it to store other valuables. So a large portion of our clients that buy and sell through ABC use our sister company Custodian Vaults for the bullion storage.
How do you charge for the storage? Because is it like a percentage of the value or percentage of the amount that they've got? Because that, I imagine, just thinking about it, just like a fund or something like that, these additional services, that storage cost, will also come out of the return.
Yeah, that's right. So sort of like the management expense built into a fund or an ETF or something like that. So again, if I maybe just quickly touch on the two options. If you use our secure storage facilities, which is with ABC, the fee for gold is 0.75% of the value per annum. So I guess if you've got $100,000 invested, $750 a year, although the dollar amount's going to move up and down with the gold value.
Is that like a managed fund? Is that calculated daily and like say charge monthly in arrears?
Calculated quarterly. So we actually break it down into 4 quarterly payments. The alternative, if you use our private vault, it's a fixed dollar rate for the vault you're hiring per annum. So, for example, a vault that could very easily fit 15 kilos of gold, which is $2 million or so, or more at today's prices, they're about $330 a year. The beauty of that is that unlike, again, our secure storage facilities, the fee is fixed and is set per annum, irrespective of the fluctuations in metal value over that time. So people that buy physical gold and that tend to see it as a strategic long-term holding in their portfolio, they're really attracted to the idea of private vaulting. We do also offer what we call pooled accounts and indeed a savings plan called the ABC Bullion Gold Saver. Those don't attract any storage fees at all. You're buying into a pool of metal rather than a specific bar. So you get the price exposure, you get the ability to convert into a physical item at any time for a small fabrication charge. So those are probably the most analogous to, say, a gold ETF, where you're buying in the case of the gold ETF, you're buying essentially a financial asset, a financial security, a share, a unit, or whatever, and it's backed by gold. Our pooled offerings work basically the same way. So there's a few different ways you can do it, and as you pointed out, different costs that will ultimately impact, I suppose, the net return an investor gets, just like they would when they're buying shares or other assets through different investment structures.
And so a day-to-day kind activity for you guys, in that shared vault, quite often, if the gold is trading between clients, essentially,
Yep.
it'd just be a ledger that you would re-recording. You wouldn't be walking in there and physically moving the gold. It remains in your vault. So it's just an ownership of that changes.
Well, so it's really important to clarify. Clients are never trading between themselves when they're trading. Yeah. They're always trading with ABC Bullion, as it were. But yeah, as a sort of standard operating procedure for our business, every single day we are moving metal into our client storage vaults. If there's been net sales, moving metal out. If people have premium storage where they literally own a specific bar with their own serial number assigned to them, well, then that specific bar is only ever going to be moved in the instance where, like Mitchell would say, you own a kilo bar of gold with, serial number 1, 2, 3, 4, 5. Well, that bar is only ever going to be moved if you've chosen to sell it and we've bought it back off you. If you said, hey, I want it delivered to me in Melbourne, we obviously arrange a logistics vendor. If you came to collect it,
you're not taking it on as carry on.
No, definitely not. Be a little bit hard to get that through the security guys and girls at the airport. But yes, it's a standard day-to-day function of ours to be moving metal due to client activity, buying and selling metal in storage, and also around our operations in Australia. So I'm sitting in our main office, our flagship store in Martin Place in Sydney, but we have offices in Melbourne, we have offices in Perth, we have offices in Brisbane. And so obviously, with a multi-billion-dollar organisation, there's precious metals that are moved securely on a daily basis.
So the question a lot of people are probably sitting there thinking as they're listening to this or watching is, why would I want the physical gold? Why would I actually want the bullion, the coins, the plates, the bars, when I can buy an ETF through my CommSec account, my Perla account, whoever my broker may be, and have it just then not have those storage issues, etc.?
Yeah, it's a good question, and it is one that we get asked even directly as well. I suppose there's 2 or 3 factors that come down to it. One is cost. And in the interest of full transparency, it is going to cost you more to buy a physical bar than it is to, say, buy an ETF. Although with the ETFs, there obviously are buy-sell spreads and there are brokerage fees on top. Then you've got the storage element and the fees there. So, gold ETFs do charge a management expense ratio and fee, which the way I look at it, not everyone, other people might have a slightly different view, but to me, that's effectively a storage cost because it's not like they're actively managing it. It's a cost to run the product, which includes storage of the bullion. Now, again, if we use an example, let's assume a gold ETF charges 0.4% per annum as a fee, and you've got your 100 grand invested. Well, that's $400 a year in fees you're paying. Yes, if you put your metal in secure storage with us at 0.75%, you'd pay $750. If you had 100 grand in pooled metal with us, you'd pay nothing. If you had 100 grand in a private vault with us, you'd pay about $300. And unlike the ETF, if the gold price doubles, well, with the ETF, if the gold price doubles, your fee doubles. In the private vault, that situation doesn't apply. So the fee one's a little bit nuanced, particularly for longer term investors. And the last one, and this is of differing importance to differing investors, but it's that security and comfort that comes with physical bullion ownership. So, it's a very fair point you raise. If you buy the physical thing, you need to think about how am I securing that? At the same time, and I can only speak from experience with the thousands of clients that we transact with every week, clearly there's a growing portion of the Australian population, and this is a global phenomenon, where people are saying, I don't just want the price exposure, I put value on owning the physical thing.
Having the real asset in their hands.
That's right. Now, I'd also add as well that I think, on balance, gold ETFs have actually been excellent for the gold industry. They were actually launched, first here in Australia just over 20 years ago. And if you look at that, I think they've been a really positive development for the industry. So a little bit like if I look at shares, I can buy them directly. I can have an actively managed fund. I can have an ETF. There are various ways of owning shares. It's not to say one is always superior to the other. There's clearly a market for both, and long may that continue.
Do you mind giving us an insight into who your clients are? Who is coming in and buying physical gold?
Yeah, another great question. So really it's Australians from all walks of life. So a lot of people would probably have the perception that to be a physical gold investor, you need huge sums of money. They've seen the movies with, the big bar.
Scrooge McDuck style,
That's right. Yeah. So there is that segment of the market, high net worths and family offices that have always been gold buyers. The biggest area of growth, probably by dollar value being invested, is coming from self-managed super funds now, Mitchell. So, if you look at the average SMSF, it's roughly $1 million, $1.1 million in assets. In questionnaires and surveys we've done with our SMSF client base, they tend to say they're putting 10 to 20% of their portfolio in physical precious metals. So typically investments of somewhere between, $100,000 to $250,000, depending on the size of the fund. There's obviously then a very significant cultural buying element to gold. So Indian clients, Chinese, Vietnamese, or people of that cultural background. And then the last one, which has been really pleasing to see, is the sort of Gen Y under 30 buyers. So what we've seen in the last year in particular is a real shift as younger investors are picking up gold exposure, and that's probably driven by the fact that gold's outperformed most things in the last 12 months, and younger investors are generally chasing capital growth. It's also a fact that, or also driven by the ways we've made gold accessible. So I sort of touched on it before. A few years ago, we started a program called the ABC Bullion Gold Saver, which lets people put as little as $50 a month into gold. Like you just sign up to a direct debit plan and you can split it between gold and silver. And that product has been, its growth it's essentially doubled year on year for the last 4 years running. So and a big part of that's being driven by younger investors, because for them, they can do 50 or $100 a week or a month. Like it's within their remit, as it were. Whereas obviously buying a kilo bar of gold at 165 grand's a bit out of budget for most investors, especially, younger ones at the beginning of their wealth creation journey.
I'd imagine a lot of those investors would actually be the children and grandchildren of your existing long-term investors.
There's a bit of crossover, and interestingly, we do see people create accounts like in trust for their kids or grandkids. But actually, it's a lot of people. When we sort of look at the numbers, we just look at the age of the primary account holder. And so when we've done that, if I look at the Gold Save program, for example, around 20-25% of the account openers are, so it sounds like a cricketing term, the openers, they're under the age of 30 now. So that's been an interesting and, in our view, welcome development.
Excellent. Now, let's get into gold as an investment, because as you mentioned, gold has had a phenomenal 12 months or longer. I tend to look at it as if gold's doing well, if gold's absolutely charging, the world's not a rosy place. It tends to be correlated with relatively with volatility, with instability, etc. around the world. Would that be a fair assessment?
Yeah, I mean, it's not a perfect one-to-one, as in gold is up, that means something else is always bad. But look, certainly, over the extreme long term, gold has built this reputation as a safe haven, and obviously people put higher value on safe havens in times of uncertainty. So that is a fair point. I mean, if you go back, let's say 25 years, which is really when the bull market in gold started, very sadly, it almost began around the time or just before the events of September 11. We'd have the NASDAQ stock crashing, around the year 2000. We've had a global financial crisis. We've had Brexit. We've had a global pandemic, Euro sovereign debt crises. So, whilst the last 25 years haven't been all bad news in terms of GDP growth, broader markets, you name it, there obviously have been significant number of events that have, for want of a better term, at least in Western markets, made investors, realize that risk is a real thing and that wealth protection, is the foundation of wealth creation. And that's part of the reason why, gold has done as well as it has. It's probably also worth pointing out, though, that there's huge consumer markets for gold in Asia, in India, in the Middle East. And the buying in those regions really has nothing to do with what the S&P 500 did overnight, or whether the Fed's cut interest rates, or the latest US CPI results. In those parts of the world, gold has always been a favoured savings asset. And what you find is that as real incomes in those parts of the world rise, and by definition, the average consumer has a little bit more spending money, well, gold demand goes up accordingly because people are saving in gold. People are buying gold in jewelry form to both store but also display their wealth. So there's what you alluded to before. There's a strong sort of element of truth to it, but it's not the whole story as it relates to investing in gold.
Let's we'll come back to that cultural element, because that's something that I had not considered, and we'd like to explore a bit more. But if gold has experienced, that bull run that you're referring to, 25 years dating back to, say, 9/11 and the Iraq, Afghanistan, etc. Post that, going forward, which is what matters to the investors, especially those approaching it now. I think the thought process in a lot of people's mind is, well, it's already run.
Sure.
What do you say to that? And where do you sit with where gold is going to be in the next 12, 24, 5 years' time?
Yeah, it's an excellent question, and one that, like, it only makes sense. It's the obvious one, really, given gold's up, let's call it 40% in the last 12 months.
Yeah, astonishing run.
Absolutely. So if you ask me, where is the gold price likely to be 5 weeks from now, I would say toss of the coin, higher versus lower, in the sense that whilst gold has had this incredible run over the 25 years, it has ebbs and flows, market gyrations. It's a volatile asset in its own right. One of the beauties of it is it's sort of negatively correlated to stock. So that whole, double negative makes a positive when you combine the two in a portfolio. But there's no doubt, given how far it's run, a period of consolidation and cooling off would actually be really healthy for the bull market in gold. Now, interestingly, if you sort of look at gold's sort of rolling 1 year returns, as I said, right now it's up about 40% year on year. In the last 25 years, gold's had 3 other periods where it's been up around that amount, or in fact even more, on a rolling 1 year basis. That was back in around 2005, again in about 2008, and then again in 2020 when COVID hit. Now, back in 2005, gold was $867 an ounce back then, when it had this huge run. It had a little bit of a correction and it's gone up fourfold since. In 2008-ish, it got to about 1,400 Australian dollars an ounce, had a little bit of a pullback, but again, it's tripled since then. And even if we go to COVID, which is the most recent example, back when it had this really frothy run up, it got to about 2,500 Aussie, had a pullback, but even if you bought at the top of that, it's doubled since then again. So I think, if you took a 5-week view, wouldn't shock to see gold lower. If you take a 5-year view, I think prices will be well supported. If you look at the demand drivers for gold, I touched on the sort of cultural element and the consumer buying in Asia, Middle East, India, etc. You've also got central banks. Central banks now buy, on average, about 1,000 tons of gold a year. That's what they've done the last 3 years. The 10 years before, they were net buyers around 400 to 500 tons a year. Really, quite sadly, since the Russia-Ukraine conflict started 2 or 3 years back, we've seen a real shift towards gold by central banks as they manage their reserve assets. Trump administration's pretty actively talking down the dollar and also very clearly trying to, for want of a better term, realign geopolitics to a degree. And that's creating uncertainty even at a nation state level. And one of the ways that central banks manage that is by saying, well, hey, I'll bolster our gold reserves because it's this hugely liquid asset that doesn't have counterparty or credit risk the way a treasury or a euro-denominated sovereign bond does. So you've got, if you look at the demand drivers for gold, the consumer markets look very strong. The central bank elements look strong. And then if we look at Western markets where people are buying bars and coins or investors, again there, if you look at gold share of total portfolios, it's still at the really lower end of the spectrum. You're typically talking maybe 1% to 2%. So I think there's very, very ample scope for demand to rise relative to how much scope there is for demand to fall. It's not to say it's an impossibility, but given the broader macro environment, given where other assets are, I would say on balance the likelihood is that the gold prices are higher 5 years from now and gold demand has continued to rise in that period.
If we can come back to the central bank buying, what does it look like when that unwinds? Like, they stop buying? Do they become sellers of it, or do they just sit on what they've got and not add more to that allocation?
Yeah, so it's a story that's sort of evolved over time. So if you go back to the sort of really from the mid 1980s all the way through to the global financial crisis hit, let's call it 15 years ago, central banks had been net sellers every year. Now, in the 90s, that was no doubt contributing to a bit of the bear market in gold. Gold bull market started around 2001. So even though central banks continued to sell for another 5 or 6 years, prices had bottomed out by then and were already going up. Last 15 years, they've been net buyers. And as I said, the trend has been that not only are they net buyers, but they're buying more and more on average each year. Likelihood is that that's going to continue at least for the foreseeable future, Mitchell. If you look at which central banks are doing the buying, it's predominantly concentrated in emerging markets. Now, emerging market nations, they'd gotten used to traditionally running huge trade surpluses and recycling large amounts of that into US and euro denominated debt. And it's not to say they've completely stopped doing that, but a far larger portion of those trade surpluses and excess capital is being parked in gold now. The likelihood is that when they, let's say, stop buying or slow down their pace of buying, that they'll just sit on what they've got. So, they're not day traders like hedge funds that are going, hey, let's buy this because we think it's got another $200 in it and then we'll turn around and, dump it into the market. That's not generally the way that central banks tend to behave. Will they always buy 1,000 tons a year? Almost certainly not, but they're likely to be on the bid and on the bid in volume for at least the next 5 to 10 years.
Excellent. So that's the bull case. So just to wrap it up, we've got some sovereign, we've got central bank purchasing, we've got trade wars and uncertainty abound, especially with the wars and whatnot that we've got going on. We've also got economic nationalism with people, defending themselves and or by reshoring industries and things like that, that isn't going to build or bolster great relationships around the world, and people want to hoard onto those, hang on to those assets. And then we've got the retail perspective, which is let's say the Asian countries. So do you mind just delving a little bit into that for us? Because that's maybe something new to a lot of people.
Into the sort of buying into non-Western markets. Yeah, sure. So I think, most people would have maybe at least a little bit of an understanding or maybe perception that obviously countries like India have had this really strong and many centuries old sort of like love affair with gold. It's given as a gift in weddings and, in all kinds of culturally significant moments. To put it in context, and obviously Australia has a huge Indian population here, on a normal day for us across our business locations, Mitchell, we might have somewhere between 200 and 300 clients walk into our stores to buy or sell or
actually physically walk in to carry gold away.
Yeah, that's right. Or some are coming in to sell, some are coming in that, let's call it 200 to 300 coming in to transact on a normalish day. 400 to 500's obviously a pretty busy day. There's obviously cultural buying or cultural festival, Diwali. It's obviously extremely important to the Indian community. Last year for Diwali, we had, I think it was 1,256 clients come through our showrooms at our showroom here in Sydney. So, that just sort of gives a sense of how significant, and that's in Australia.
And that's growing?
Absolutely. It's like triple in the last 4 years. It's just been unbelievable. But obviously that's what we see in Australia. We hear stories from counterparts and just people we know in the industry overseas, and you hear the stories of lineups for hours and you name it. So obviously India's got this huge, as I say, like cultural love affair and affinity for buying gold. China really opened up and liberalized its gold market 20 plus years ago. It's now the largest both producer of gold and consumer market. And when I say consumer market, I mean both jewelry as well as bars and coins combined. Other parts of Asia, Thailand, Vietnam, also very strong. Malaysia, Indonesia, huge markets for gold. And the Middle East is another one as well. Again, as I sort of mentioned before, when you look at these countries, gold demand is highly correlated to rising incomes. So, in investor conferences in the past, I've often spoken about gold. Like if you have a semi-bullish view on emerging markets, and by that I mean you believe that emerging markets are going to play a bigger role in the global economy, that essentially the gap between the West and the rest is going to continue to narrow, well, you should expect gold demand to rise, because as people in those nations earn a little bit more money, have the capacity to save a little bit more money, it's not going to go up week to week, month to month necessarily, but the trend is that gold demand will rise from buyers in those markets.
Jordan, I'm interested. Can you make a bear case for gold today?
Yeah, absolutely. Yeah. I mean, the short-term bear would just be, it's been an incredible 12 months and the market could just cool off. If you were to make a long-term bear case for gold, what would be the ingredients you'd expect to see? You'd expect to see the US dollar rallying. You'd expect to see yields across the curve, especially at the longer end, rise quite significantly. And you would expect to see a fairly significant bull market in, let's call it risk assets, so equities basically. And you'd expect a calming of tensions on the geopolitical front and relatively healthy growth in the economy. There's 4 or 5 things there that I've listed. Whilst all of those things could happen, I think the likelihood is that most of them won't happen, right? In the sense that, look, I own equities in my portfolio. I hope they continue to go up. But I think it was Bridgewater themselves had a paper out earlier this year where they said, like, the last 15 years have been the best 15 years for equities in really the last 100 years combined. If you took rolling 15-year returns, markets have had a huge correction in the last month or so, but then made most of it back. they're not cheap. It's not to say they're going to crash or whatever, but a period where returns maybe just aren't as high as they've been wouldn't be unexpected. If we look at interest rates, well, they're coming down, not going up now. Inflation is moderated, but it's still above the 2% mark that most central banks would aim for. That golden era of almost deflation or almost zero inflation is probably in the past now. You yourself mentioned it, that potential for whether we call it economic nationalism or just reshoring, onshoring, all of those things have implications, upside pressure on inflation. So yeah, I mean, the gold price isn't going to go up forever. That's for sure. Just like no asset class does. There is a case to be made. Here are the things that could cause it to fall. On balance, though, my personal view is that most likely it rises for all the reasons that I've already spoken about.
And just quickly, you mentioned most people have a smaller portion of gold in their portfolio, 2%, 2.5%, whatever. In your view, a retiree, what percentage someone in retirement should have versus, say, the percentage that someone who's growing and got a long-term time horizon, many years of compounding ahead of them?
Yeah, it's an interesting one. I mean, obviously, number one, can't give advice on everyone's situation.
Go and speak to your financial advisor.
Exactly. FTSE had a little paper out, I think it was mid-April, where they looked at the returns of a traditional sort of 60-40 portfolio, and then they recut it doing 60% equities and basically cutting the bond allocation in half and putting it in gold instead. So it's like a 60-20-20. And they found that, effectively the risk-adjusted returns were way higher by including that gold allocation. And their end sort of summary was that, look, gold shouldn't just be looked at as this defensive risk-off asset. It should sort of be a strategic holding. Now, look, that's not to say 20% is the right number for anyone.
No, if you did that, you would also be cutting your income as well
correct.
That these people require.
That's right. And so it depends. I mean, I think there's a logical case to make that, probably as you're a little bit younger and gold's generated, even forget the last year, at which has been extraordinary returns. The long run return of gold's been around 8.5%, 9%, which is pretty strong.
Which is like a standard equity market, like a S&P 500, ASX 200-300.
That's right. And so I think, if you're in, let's say you've got a self-managed super fund and you're in your 40s, well, whether the return you get comes from income or capital doesn't really matter because you can't take the money out, or it doesn't matter the same way it might to a retiree who actually needs cash flow from their investments. In fact, you could make a case that, particularly for younger people, once you factor in tax, and again, another disclaimer, not giving tax advice here, but an asset that delivers its return on capital only should, all other things being equal, be better than something that's half capital, half income, because you can kind of defer potentially defer the tax depending on when you sell the asset, if that makes sense. Although I know there's also talk about them bringing in taxes on unrealized gains now, so maybe that might become a moot point, depending on someone's balance. But I don't think it's not as simple as saying retiree should be 10%, pre-retiree 15%, younger investor 20%, or 25%. It is up to the individual, but I think there's a huge body of research now, even coming from people that don't have skin in the gold game, as it were, that show that, whether it's 10%, 15%, somewhere around that 20 mark, that can really improve the risk-adjusted returns of a portfolio. And that's before, even factoring in some of those additional benefits around, the liquidity of gold, the fact that especially if you own it physically, there's no credit risk with the asset, some of those other defensive attributes that don't show up in a spreadsheet, as it were, but nonetheless are important to, a larger and larger group of investors every day now.
Awesome. Jordan, this has been a great deep dive on gold as an asset and gold in portfolios. I've really appreciated the insight as well to how your business actually runs and the physical storage of it and everything. So we'll put notes in the links in the show notes how people can go over and get in touch with ABC Bullion. And if you're in Martin Place, you can pop on in.
We'd love to see you. Thanks, Mitchell. Really enjoyed the chat.
Cheers, Jordan.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.